You were told money is neutral. You were told inflation is natural. You were told debt is a choice, and prosperity is just a matter of working harder. But what if none of that is true? What if the pressure you feel, the constant struggle to stay ahead, the sense that no matter how much you earn, you never truly catch up, isn't an accident, a failure of discipline, or bad luck? What if it's the outcome of a financial war that began long before you were born? A war you never consented to, never saw declared, and were never told you were fighting in. Tonight, we're not talking about a market crash, a recession, or a single corrupt banker. We're talking about a system. A system designed through policy, power, and psychology. And by the end of this story, the question won't be, is this real? It will be, how did we miss it for so long? To understand this war, we have to go back, not decades, but centuries, to the moment money stopped being a tool and became a weapon. For most of human history, money was limited by something real: land, labor, gold, silver. You couldn't create it without effort, and power was constrained by scarcity. Kings went broke. Empires collapsed when resources ran out. Financial limits were political limits. That changed when banking evolved. The first twist came with early central banks, particularly in Europe. These institutions discovered something revolutionary. You don't need to own all the money you lend. You only need confidence. As long as not everyone asks for their money back at the same time, you can lend far more than you actually have. This idea of fractional reserve banking quietly rewrote the rules of power. Money could now be created as debt, and whoever controlled debt controlled the future. At first, this system grew slowly, almost invisibly. Governments liked it because wars could be financed without immediate taxes. Banks liked it because interest turned time into profit. Citizens barely noticed until the consequences began to compound. Fast forward to the 20th century, the world had just survived 2 devastating wars. Nations were exhausted, currencies unstable, and trust fragile. In 1944, global leaders gathered to design a new financial order, one that promised stability, cooperation, and peace. This was the Bretton Woods system. Currencies were tied to the US dollar. The dollar was tied to gold. And gold was supposed to keep everyone honest. For a while, it worked. Growth was real. Wages rose. Productivity was rewarded. One income could support a family. The system appeared fair. But behind the scenes, pressure was building. Wars were still being fought. Spending was exploding. And there was one problem no politician wanted to face. There wasn't enough gold to support the promises being made. So instead of shrinking the system, leaders chose to break the constraint. In 1971, a single announcement changed everything. The gold backing was removed. Money was fully untethered from reality. From that moment on, money was no longer a representation of value. It became a political instrument. This is where the financial war truly begins. Without a natural limit, currency creation accelerated. Debt became the default solution to every crisis. Economic pain was postponed instead of resolved. And each delay required more money creation than the last. The effects weren't immediate. That's what made it brilliant and dangerous. Inflation didn't explode overnight. Instead, it seeped in quietly. Prices rose slowly. Assets rose faster. Those who owned assets grew richer. Those who relied on wages fell behind, but not enough to revolt. This was phase 1 of the war, erosion without alarm. Then came the rise of financialization. Banks stopped being intermediaries and became architects. Markets stopped reflecting reality and started shaping it. Complex derivatives, leverage, and speculative instruments multiplied far beyond the real economy they were supposed to serve. Money began chasing money, not productivity. Housing transformed from shelter into an investment vehicle, and education became a debt contract. Healthcare became a billing system. Even retirement was handed over to markets that required constant growth to survive. And here's the key cause and effect. When an economy depends on ever-expanding debt, stagnation becomes catastrophic. So growth had to be forced. Interest rates were lowered, then lowered again and again. Each cut rewarded borrowing and punished saving. Risk-taking wasn't just encouraged, it was necessary. This led to the breaking point. In 2008, the system cracked. Decades of leverage collapsed under their own weight. Banks failed. Markets froze. The illusion shattered briefly. For a moment, it looked like accountability might arrive. Instead, the war entered its most revealing phase. Losses were socialized. Gains were protected. Money was created in unprecedented amounts, not to rebuild the foundation, but to stabilize the same structures that caused the collapse. Quantitative easing wasn't a fix. It was a ceasefire that favored one side. Asset prices soared. Inequality exploded. Trust eroded. The public was told this was recovery. Then came the fallout. Wages stagnated despite rising productivity. Younger generations accumulated debt faster than assets. The cost of living rose faster than official inflation numbers admitted. Savings lost purchasing power year after year. People worked harder, studied longer, saved more, and still fell behind. This wasn't mismanagement. It was the logical outcome of a system designed to extract value upward through time. Every solution followed the same pattern: more debt, more liquidity, more central control. Failed fixes stacked on failed fixes, each one increasing dependency and reducing resilience. Then came the modern parallels. A global pandemic froze economies. The response was instant and massive. Trillions created. Interest rates pinned near zero. Asset markets detached completely from lived reality. Once again, the pattern repeated. Those closest to money creation benefited first. Prices rose later. Wages adjusted last, if at all. The shock wasn't the crisis. The shock was how familiar the response felt. This is the war you were never told about. It's not tanks and soldiers, but incentives and structures. Not borders, but balance sheets. Not victories, but dependencies. And the most effective weapon wasn't force. It was normalization. So what does this mean for you right now? Here are 3 clear takeaways. First, this system isn't broken. It's doing exactly what it was designed to do. Understanding this changes how you interpret news, policy, and promises. It shifts the question from why is this happening to who benefits when it does. Second, wealth preservation and wealth creation follow different rules than income. In a debt-based system, cash loses value over time. Its assets, scarcity, and adaptability matter more than obedience and effort alone. Third, awareness is not pessimism, it's preparation. You don't need to panic, but you do need to stop assuming the system is neutral or permanent. Here's the warning. Systems built on confidence survive till they don't, and transitions never announce themselves politely. The open-ended question, isn't whether change is coming, it's who will understand it early enough to adapt. If this video challenged your assumptions, share it with someone who still thinks the struggle is personal failure. If you want more stories that explain the hidden mechanics shaping your life, subscribe and stay curious. Because the most dangerous wars aren't fought in secret. They refought in plain sight against people who were never told they were on the battlefield.